Have you seen this statement? This is known as a K-1's statement. If you're thinking about becoming a business owner or you just want to be an investor, this statement is absolutely crucial for you to understand the mechanics of how it works and what it does. And that's what we're going to cover in this short video. And this topic was suggested by Dave, a longtime subscriber of the channel. Dave, thanks so much for the topic suggestion. I've been wanting to do this one for a while, and your comment was a great reminder that I needed to do so. So thank you so much, sir. Hi, my name is Mike, and my passion is helping people learn how to operate more like a business owner or investor to grow their wealth while learning how taxes work. First of all, what is a K-1?
Well, I can tell you that it's not a statement that it eventually evolves into a K-9, because that would be pretty cool.
A K-1 is an IRS tax form statement that comes from an entity.
But not this kind of entity. Like the entity in the movie, It Follows.
And by entity, it could be one of several kinds. It could come from an LLC, an S corporation, a partnership, or even a trust as an example. All of those entities are known as pass-through entities. When they say pass-through entity, what they mean is that the income and expense attributes, the tax attributes of that entity's activity for the year, pass through to you personally as a shareholder, partner, member, or beneficiary of that entity. And those income and expense attributes are given to you on a K-1 based on your ownership percentage in that entity. And then you are to report your share of those income and deductions on your personal tax return. The K-1 statement is showing how much of the income and deductions you get to report on your taxes based on how much of that entity you own. Simple example would be if the business you own made $100 in profit for the year. And let's say that you are a partner or a member of this business and there's a bunch of other people involved. And so you only own 5% of the business in total, only 5%. So of that $100 in profits, you would be entitled to only $5 of that profit. The $5 will be reported on the K-1 statement as ordinary business income. And you'll report $5 of ordinary business income on your tax return. So from that, I think you can quickly see how the business itself is not paying tax. The tax burden's passed through to you as the business owner, and you're going to pay the tax on that based on your marginal tax rate.
These business entities that pass through income to their shareholders, although they might not be subject to taxes, some of them may be subject to state taxes. And even if they don't have to pay any tax at all, they are still required to file a tax return. And the tax return is what actually generates the actual K-1 statement for each investor or owner.
Now you could say, but Mike, I don't own a business. When will I ever see this? Well, if you invest, you very well might invest in a publicly traded partnership. And if you invest in a publicly traded partnership, they're going to send you a K-1 statement in the mail, and you're going to report that investment activity. I have several clients who have numerous K-1s from all different kinds of publicly traded partnerships that I'm reporting on their tax return every single year. And they're not business owners. They primarily function as employees, but they have investments in businesses. The most common kinds of questions I get from YouTubers or viewers such as yourself about K-1s is, where do I even report this type of income or deductions? Well, it really just depends on how the business operates. If the business you own or invested in primarily has rental income, well, it's going to pass through rental income to you, and it's going to be netted against your other rental income and losses. If the business is passing through dividends on the K-1, well, then the dividends are going to show up on Schedule B once you've entered that into your tax software. And please don't ask me where to enter it in TurboTax. I don't work for TurboTax, and I do not use TurboTax. So please don't ask me that question. Ask a TurboTax representative for something like that. But where the source of the income is coming from is going to determine where it's reported on your personal return. If let's say the LLC has long-term gains or short-term gains, well, that income or loss is going to be reported on Schedule D, right? Because that's where capital gains and losses are reported for other investments, Schedule D. And so it really just depends on what types of income and losses you have passing through to you on your K-1 is going to determine where it goes on your tax return. And don't be surprised if you're invested in a large business, let's say like a BlackRock or Blackstone, that K-1 statement might have numerous different kinds of income and expense attributes, whereby that one K-1 statement might actually populate all different sorts of tax forms on your personal return. Also on the K-1, besides showing your income and expense attributes, your ownership percentage, is the different kinds of debt you might be personally liable for. Sometimes you're personally liable, sometimes you're not. It depends. So there's non-recourse, there's qualified non-recourse financing, and there's recourse financing, which I'm not going to cover in detail in this video. It's way too convoluted, and for most people, this is not even applicable, to be honest. If you do owe debt to the entity, it does give you extra basis to deduct losses if you have losses passing through here to deduct on your personal return, which is quite nice. So sometimes the debt itself, if you have debt to the LLC or partnership, is going to help you deduct losses you have with the entity. Another extremely important part of this form is the partner capital analysis near the bottom. And it talks about your capital account, which is basically how much you've invested in the entity and how much basis you have to take losses if the entity is having losses. And it shows things like how much capital or money you put in or money you invested into the business this year. That raises your basis or your capital account. It shows if you have net income, that raises your capital account. If you have net loss, that reduces your capital account. Or if you have other, increases and decreases in your capital, you would report that there. And also if you take money out, if you withdraw money, that's going to reduce your partner capital account. Now, once your capital account gets to zero or becomes negative, then there's usually some things you need to do to restore it at least back to zero. And if you have a negative capital balance or a zero capital balance, then what's going to happen is if your entity has a loss on the K-1 statement, those losses are going to be suspended. You don't lose them, but they're suspended, meaning you don't have any basis to take the losses. And so the business either needs to make more money, you need to invest more in the business, or various other factors to restore your capital account so you can deduct losses once again. And there's an entire textbook just on that little box because it's so complex the way they've designed the tax system. So I'm not going to go into any further detail on that in this video, but I just wanted to explain why it's there and why it is so extremely important for you to personally track that information. It's not your CPA's job to do that. It's actually your job to keep track of your capital account and all of your individual investments throughout the year. Okay, so we just talked about where K-1s come from, which is from pass-through entities, when you'll get them, which is if you have ownership percentage in a pass-through entity, and what to do with the K-1 statement when you receive it, which is to report it, the different income and deduction attributes on your personal tax return to learn how to better operate your business, grow your wealth, and save on taxes along the way. Make sure you subscribe by hitting the red subscribe button down below. If you're needing help with your accounting or tax matters, I work with individuals, business owners, trusts and estates, nonprofits, and investors throughout the country. And you can reach me through my website at MikeKellyCPA.com, and feel free to reach out to me. We'll discuss what your needs are, and I will provide you a quote of what it would take to perform the work. Until next time, have a wonderful week, and I'll see you in the next video.